Before you dismiss this as another market correction, before you check your portfolio and go back to sleep, I need you to understand something. Right now, at this exact moment, while you're watching this, there are cargo planes taking off from London Heathrow, loaded with silver bars, flying east, not because of supply chains, not because of logistics, but because the same ounce of metal that trades for $106 in New York is being purchased for $126 in Shanghai. A $20 gap, a 20% premium that shouldn't exist, that cannot exist in a functioning market. And yet, it does. The vaults are emptying, the refiners are running 24-hour shifts and still can't keep up, and the banks are raising margin requirements to $51,000 per contract. Not to protect you, but to protect themselves. This is not a correction, this is a countdown. Welcome to Boring Currency Analysis, the channel where we don't waste your time with hype. Just the intelligence you need to make informed decisions. Now, if you've built your wealth through decades of experience, if you understand that real money isn't made chasing trends but understanding systems, then I'd appreciate it if you'd subscribe. Not because I need the number, but because the next 18 minutes might be the most important briefing you hear this quarter. And before we dive in, drop a comment below. Where are you watching from? New York, London, Dubai, Singapore? Because what's happening in the silver market right now doesn't respect borders. It respects physics. And physics is about to win. Let's begin. There's a fundamental rule in global economics that most people take for granted. An identical product should cost roughly the same price everywhere in the world. An iPhone in Los Angeles costs the same as an iPhone in Tokyo, give or take shipping and taxes. A barrel of oil in Texas trades at nearly the same price as a barrel in Saudi Arabia. This is not a coincidence. This is arbitrage. When a price difference appears between two markets, traders immediately exploit it. They buy low in one location, sell high in another, and the gap closes within hours. This mechanism keeps the global economy balanced. It prevents one region from being systematically drained by another. But today, January 28th, 2026, that mechanism is broken. We are witnessing a price dislocation in the silver market that defies every principle of modern finance. And the consequences are not theoretical. They are measurable, they are accelerating, and they are stripping wealth from the Western Hemisphere at a rate that should alarm every serious investor. Let us examine the numbers. On the COMEX exchange in New York, the paper price of silver closed yesterday at $106.15 per ounce. If you're a Western trader watching your screen, you saw red candles, you saw panic selling. You might have thought the rally was over. Now, let us shift our attention 7,000 miles east. On the Shanghai Futures Exchange, that same ounce of silver is trading at $126.95. Not 107, not 110, $126.95. The difference is 20.80 per ounce. In percentage terms, this represents a 20% premium. To understand how extreme this is, we need context. In normal commodity markets, a 1% spread between exchanges is considered significant. A 2% spread triggers immediate arbitrage activity. A 5% spread would cause emergency meetings at central banks, but 20%? A 20% spread is not a market inefficiency. It is a structural breakdown. It is a signal that the pricing mechanism itself has failed. Now, let us consider what this spread does to the physical supply chain. Imagine you are a silver refiner in Zurich. You have just produced a 1,000-ounce bar of 999 fine silver. Your phone rings twice. On the first call, a banker from JP Morgan in New York offers you $106 per ounce. Total payment of $106,000. On the second call, a state-owned trader from Shanghai offers you $126 per ounce. Total payment, $126,000. The decision requires no analysis, no committee meeting, no risk assessment. You sell to Shanghai, you take the extra $20,000. You arrange air freight to China, and you never look back. This is happening right now, not in theory, in practice. We are seeing documented reports from bullion dealers in London, refiners in Switzerland, and wholesalers in Australia. They are diverting shipments. Planes that were scheduled to land at JFK Airport in New York are changing flight plans mid-route. Ships carrying silver bars from Peru are bypassing Los Angeles and heading directly to Shanghai. The metal is flowing east, not because of tariffs, not because of sanctions, but because the price in the east is $20 higher than the price in the west. This creates what economists call a one-way drain. Every day this spread exists, the Western vaults lose inventory. Every day, another 1,000 bars leave London. Every day, another refiner ships to Shanghai instead of New York. The COMEX, the exchange that has set the global price of silver for decades, is being systematically emptied. And here is the truly remarkable part. The bankers in New York think they are winning. They look at their screens and see that they successfully suppressed the price to $106. They pat themselves on the back for controlling inflation and managing volatility. But while they celebrate their paper victory, their physical vaults are being drained. They are winning the battle on the screen while losing the war in the real world. This is not a temporary anomaly. This is not a glitch that will self-correct by next week. This $20 gap represents something far more serious. It represents the beginning of a wealth transfer from the Western financial system to the Eastern industrial powers. It represents the mechanism by which one civilization extracts resources from another without firing a single shot. The question is not whether this spread will close. The question is how. Will New York's price rise to meet Shanghai? Or will New York's vaults simply run empty? To understand the answer, we must first understand why this dislocation appeared in the first place. We must examine the foundation beneath both markets. We must talk about the dollar. Most people make a critical mistake when analyzing market prices. They focus on the asset moving up or down. They watch silver, they watch gold, they watch stocks. But they forget to watch the measuring stick itself. They forget that every price is denominated in something. And when that denominator collapses, every number becomes meaningless. You cannot measure accurately with a broken ruler. For the past 80 years, the US dollar has been the ruler by which humanity measured all economic value. It was the constant, the North Star, the one thing that supposedly held steady while everything else fluctuated around it. But that era has ended. The North Star is dying, and what we are witnessing in the silver market is simply the first visible symptom of a much larger disease. Let us examine the patient. The DXY, the dollar index, measures the strength of the US dollar against a basket of major foreign currencies. It includes the euro, the yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. For years, this index held above 100. It represented American economic dominance, but over the past 12 months, something has broken. The DXY has been in free fall. Last week, it smashed through the critical support level of 96. As of this morning, it sits at 95.8. This is not a minor technical correction. This is a structural failure. Year over year, the dollar has declined 10.7%. Let that number settle for a moment. If you held $100,000 in cash in a savings account 1 year ago, and you did not spend a single dollar, you now have the global purchasing power of $89,300. You lost over $10,000 without making a single bad decision. You were robbed while you slept. But the true damage becomes visible only when we examine individual currency pairs. Against the Swiss franc, the dollar is down 14.1%. Against the euro, down 15%. These are not small moves. These are tectonic shifts. The Swiss National Bank, the European Central Bank, the Bank of Japan are all watching the same chart, and they are all drawing the same conclusion. The dollar is no longer a safe haven. It is a sinking ship. So what do? They diversify. They rotate out of treasury bonds. They reduce their dollar reserves, and they move into tangible assets, real estate, commodities, and most importantly, metals. Silver and gold have no central bank behind them. They have no counterparty risk. They cannot be printed into oblivion by a desperate government. This is why the demand from Asia, from the Middle East, from Europe has exploded. But here is where the situation becomes dangerous. In the West, most people still do not see the problem. They look at their brokerage accounts and see green numbers. The S&P 500 is making all-time highs. The Nasdaq is climbing. Their 401k statements look healthy, so they assume everything is fine. But let us ask a more difficult question. If your currency is collapsing, does your stock market go up or down? The instinct is to say it goes down, but history tells us the opposite. In 2018, Venezuela's currency collapsed into hyperinflation. The bolivar became worthless. People were eating zoo animals to survive. And the Caracas Stock Exchange then became the best performing market in the world. It went up thousands of percent. Did Venezuelans get rich? No, they got poor. The stock prices went up because the currency went to zero. The numbers increased, but the value disappeared. This is the illusion we are living through right now in America. The S&P 500 is not rising because companies are generating more real wealth. It is rising because the dollars used to measure those companies are worth less every single day. You're not gaining purchasing power. You are running on a treadmill just to stay in place. Now, let us connect this back to silver. Beijing understands this dynamic better than anyone. They have been watching the dollar weaken for years. They have watched the Federal Reserve trap itself. If the Fed raises interest rates to defend the dollar, they crash the economy and trigger mass unemployment. If they lower rates to stimulate growth, they accelerate the dollar's collapse. It is checkmate. There is no move left that saves both the currency and the economy. So China has made a calculated decision. They will not wait for the dollar to collapse completely. They will not sit on a mountain of depreciating treasury bonds and hope for the best. Instead, they will use this moment of weakness to execute the largest resource acquisition in modern history. They will drain the West of its physical assets, while those assets are still cheap. And they will do it using the very market mechanisms that the West created. The $20 arbitrage gap is not an accident. It is a weapon. And Beijing is pulling the trigger every single day. War has changed. In the 20th century, empires were built and destroyed with tanks, aircraft carriers, and nuclear warheads. Borders were redrawn by generals. Resources were seized by soldiers. Victory was measured in territory controlled. But in the 21st century, the most effective warfare is invisible. No troops cross borders, no missiles are launched, no declarations are made. Instead, one nation simply opens its wallet, and the wealth of another nation flows directly into it, automatically, legally, irreversibly. This is economic warfare, and China has just deployed the most elegant weapon system ever designed. Let us reverse engineer the strategy. Beijing is sitting on approximately $800 billion in U.S. Treasury bonds. These are IOUs from the American government, promises to repay with interest. But there's a problem. As the dollar collapses, these bonds lose value every single day. China is holding depreciating paper. They could wait for maturity, collect their dollars, and watch those dollars buy less and less in the real world. Or they could do something far more intelligent. They could trade the paper for something physical, something finite, something the world will always need: silver. But here is the brilliance of the operation. China does not need to spend its treasury reserves to buy silver. It has something even better. It has a printing press. The People's Bank of China can create yuan, its domestic currency, in unlimited quantities. And because China controls its own exchange, the Shanghai Futures Exchange, it can influence the price of silver within its borders. So here is what they do. Step 1, allow the price of silver in Shanghai to rise significantly above the global average. Currently, $126.95 per ounce. Step 2, sit back and let capitalism do the rest. When silver trades for $106 in New York and $126 in Shanghai, every rational actor in the supply chain makes the same decision. They sell to Shanghai. The refiners ship east. The dealers ship east. The wholesalers ship east. China does not need to invade. It does not need to sanction. It does not need to negotiate. The invisible hand of the free market delivers the metal directly to Beijing's doorstep. And what does China pay with? Yuan. Printed currency, paper that costs nearly nothing to produce. They are trading infinite paper for finite metal. They are trading promises for atoms. When the global financial reset occurs, and it will occur, who wins? The country holding a vault full of printed currency, or the country holding a vault full of silver? The answer is obvious. Now, let us look at the evidence that this strategy is working. Over the past 6 months, multiple refiners have reported unprecedented demand from Asian buyers. Bullion dealers in London have confirmed that shipments originally designated for Western clients are being redirected mid-transit. Flight manifests show air cargo routes shifting. Planes that typically fly from Zurich to New York are now flying from Zurich to Hong Kong. Ships leaving Australian ports are bypassing traditional routes to North America and heading directly to Chinese-controlled ports. This is not speculation. This is documented logistics. The metal is moving, and it is moving in one direction. East, let us calculate the scale. If the average daily arbitrage flow is even 100,000 ounces, that equals $12.6 million worth of silver moving to China every single day at Shanghai prices. Over a month, that is $378 million over a year, $4.5 billion in physical metal transferred from west to east. But the real number is likely far higher, because we are not just talking about individual traders exploiting the spread. We are talking about state-backed institutions with access to unlimited credit executing this trade at industrial scale. China is not buying silver to speculate. It is buying silver because it needs it. Silver is required for solar panels, for electric vehicle batteries, for military-grade electronics, for 5G infrastructure, for missile guidance systems. Every ounce of silver that lands in Shanghai is an ounce that strengthens China's strategic position and weakens America's. And here is the final piece of the puzzle. If China can drain the COMEX, if it can empty the registered vaults in New York, then something extraordinary happens. The pricing power shifts. For decades, the price of silver has been set in London and New York. The London fix and the COMEX close determined what the rest of the world paid. But if New York runs out of physical inventory, it can no longer set the price. You cannot price what you do not have. The power shifts to whoever holds the metal. And that is Shanghai. Imagine a world where American manufacturers need to buy silver, but they must call Shanghai for a price quote. Imagine a world where the United States, the architect of the global financial system, becomes a price taker instead of a price maker. That is the end game. That is what this $20 arbitrage spread is designed to accomplish. China is not just buying metal, it is buying sovereignty. And the West, trapped in its own paper illusions, is letting it happen. But empires do not go quietly into the night. When the bankers in New York finally realized what was happening, they launched a desperate counterattack. They could not find more metal, so they decided to attack the buyers instead. There's a moment in every losing war when the defeated side realizes it cannot win through conventional means. The troops are exhausted, the supply lines are cut, the enemy is advancing. And so, the losing side does the only thing it has left. It cheats, it changes the rules, it flips the board. This is exactly what happened last week in New York. The CME Group, the parent company of the COMEX, issued an emergency directive, effective immediately. The margin requirement to hold a single silver futures contract has been increased to $51,977. Let us pause and understand what this number represents. A standard silver futures contract controls 5,000 ounces of metal. In normal market conditions, the margin, the deposit required to hold that contract, ranges between $8,000 and $15,000. This allows traders to use leverage. It allows the market to have liquidity. It allows price discovery to function. But 51,977, that is not a margin requirement. That is a ransom. Here is how the weapon works. Imagine you are a hedge fund manager. You're holding 50 contracts of silver, representing 250,000 ounces. You believe the price is going to explode. You have done your research. You understand the arbitrage. You're positioned for the breakout. Then, at 4:00 p.m. on a Friday afternoon, you receive an email from the exchange. It says, due to increased volatility, margin requirements have been adjusted. You must wire an additional $2.1 million to your account by Monday morning, or your positions will be liquidated. You do not have $2.1 million in cash sitting idle. You are fully invested. Your capital is deployed. So what do? You have two choices. Sell your silver position or face forced liquidation. Most traders choose to sell. They have no other option. This creates a cascading wave of forced selling. Thousands of contracts hit the market at once. The price collapses. Not because supply increased, not because demand decreased, but because the exchange rigged the rules to force traders out of their positions. This is why the paper price in New York crashed to $106, while Shanghai remained at $126. The price drop was artificial. It was engineered. It was a controlled demolition designed to create panic and to protect the banks that are short silver. But here's the fatal flaw in their strategy. The margin hikes only affects leveraged traders. It only affects speculators using borrowed money. It does not affect the buyers in Shanghai. China is not buying silver on margin. The People's Bank of China does not use leverage. The state-owned enterprises purchasing metal for industrial use are paying 100% cash up front. So when the COMEX raises margins, it forces Western traders to sell, but it does absolutely nothing to stop the Eastern buyers. In fact, it makes the problem worse. By smashing the paper price to $100, the COMEX has just made American silver even cheaper for Chinese buyers. They have put the metal on sale. They have rolled out a discount for Beijing. It is economic suicide disguised as risk management. But the margin hike is only one front in this war. The second front is information. Over the past 2 weeks, a coordinated media campaign has flooded financial news outlets. Articles with titles like "Why Silver is a Trap for Retail Investors" have appeared on Bloomberg. Segments on CNBC warn viewers about liquidity concerns in the precious metals market. Opinion pieces claim that silver is overvalued and due for a correction. Do you believe this is a coincidence? Do you believe that in the middle of a currency collapse, in the middle of historic arbitrage spreads, in the middle of a supply shortage, financial journalists just randomly decided to write negative articles about silver? No, this is narrative control. This is psychological warfare. The goal is simple: convince the American public not to buy. Because if even 1% of retirement savings in the United States moved into physical silver, the COMEX would break in 48 hours. The vaults would be empty by Wednesday. The entire pricing system would collapse. So they must prevent demand. They must scare people away from the one asset that is actually protecting wealth during this crisis. But while the media tells you to sell, the people who actually handle the metal are saying the exact opposite. PAMP Suisse, one of the largest and most respected refineries in the world, released a statement last week. They said, "We are seeing demand at levels we have really not seen before." Not in 2008 during the financial crisis. Not in 2011 during the European debt crisis. Not in 2020 during the pandemic. Now, right now, January 2026. They are running their foundries 24 hours a day, 7 days a week. They are paying workers triple overtime, and they still cannot keep up with orders. If you place an order for a 1,000-ounce bar today, The delivery date is April, 3 months from now. You are not buying metal, you are buying a promise that maybe, if everything goes well, they will have a bar for you in 90 days. This is the reality on the ground. The physical market is on fire. The refiners are overwhelmed, the wholesalers are sold out. And yet, the paper price is going down. This is the clearest signal you will ever receive. When the price drops, but the shortage gets worse, the pricing mechanism has failed. The market is no longer discovering value. It is obscuring it. The COMEX can raise margins to $100,000 per contract. The media can run 1,000 articles telling you silver is worthless. The banks can short the market into oblivion. But they cannot change the laws of physics. They cannot print silver. They cannot create supply that does not exist. And they cannot stop the $20 arbitrage spread from draining their vaults. The endgame is mathematical. Either the COMEX admits defeat, lets the price rise to match Shanghai, and the shorts are wiped out overnight. Or the COMEX keeps fighting, keeps the price suppressed, and the vaults hit zero. When inventory reaches zero, the exchange will be forced to declare force majeure. They will stand in front of the world and say, "We cannot deliver the metal." And when that happens, the price does not go to $130. It goes to no offer. It goes to a place where dollars are no longer accepted as payment. The window to position is closing, not because the price is rising, but because the metal is leaving the continent. This is not financial advice. This is a strategic warning. The $20 spread is still open, the vaults are still draining, and the empire is running out of moves.